The US Fed has left interest rates unchanged at its September policy meet, unexpected lines. But it did deliver what was considered a hawkish pause. Lata's here with her editor's take on how it affects India and the macros.
Well, first up, what changed and what did not? Well, what did not change, we all know. Rates did not change, but a lot other things have changed. First, on the dot chart, along with the Fed statement, all the Fed members vote on where they see the Fed funds rate 1 year from now, 2 years from now, 3 years from now. That has changed from what they voted in June. The dot chart in June had indicated 4 cuts in 2024. Today's chart indicates only 2 cuts, so 50 basis less in terms of cuts. For 2025, they'd originally said 2 cuts, they've maintained 2 cuts. But what has happened is net, the total number of cuts is 50 basis points less. So whereas the Fed funds rate was expected to end at 2.5%, now the terminal rate is 2.9%. That makes a world of difference on how you draw the yield curve. So the yield curve has to factor in that 50 basis extra when you're factoring long-term rates, which is why the 10-year yield has also gone up to, the highest since 2007. Now, what changed in the statement? In the statement, what has changed is actually marginal. Economic activity has been characterized as expanding at a solid pace. Now, the previous time they had written moderate. So, they're much more confident that economic growth is going to be robust. Job gains, not much. They have said have slowed in recent months, but remain strong. Last time they had said robust. So just a minor dilution. Now, what is more important is what they have changed in terms of economic projections. Very important. The 2023 GDP forecast, originally at 1%, has now more than doubled, 2.1%. Central banks are always the conservative force in the market. And the conservative guy is saying that GDP growth pace is double what I thought it was just recently, in June. Core PCE price index, for inflation, they don't look at CPI, they look at core PCE. That index they had expected will go by 3.9. Now they're expecting rise only by 3.7. So look at the best of things. Growth higher than expected, much higher than expected. Inflation lower than expected. Can you ask for better Goldilocks? And finally, unemployment originally was seen at 4.1%. Now they expect it will only be 3.8%. Slightly hawkish, which means there will be more jobs available and less unemployment, which means that will be an upward pressure on inflation. But look at the scenario. In terms of growth, there will be lesser unemployment and pace of growth is double. So, the Fed is very strongly betting on a soft landing. For the rest of us, for whom the US economy has to tick so that our exports and generally the global economy ticks well, this is actually a bullish sign. This is a pro-growth sign. Market may react negatively now, but there is nothing in the data to generate a big fall in equities. If anything, it is actually equity supportive.
All right, Lata, thanks a lot for getting us all of the highlights and the editor's take on the Fed decision that came through. By the way, this week is very heavy on central bank action here. The Bank of England, Bank of Japan, Swiss National Bank, all of those this week. So very important to track. But with that, it is time for a short break. Now, on the other side, we're going to discuss what has happened to the commodities ever since this rate decision did come out. We'll get Manisha in with all of those details.